Why would you want to pay taxes in the future when taxes could be higher? Today we're going to dive into everyone's favorite topic, which is taxes and how to pay less legally. My name is Amanda Ryba, and I've been a licensed financial coach and consultant for the past 10 years. And for the past 3.5 years, I've been producing content on social media, educating people how to legally pay less in taxes. Because the big question everyone has been asking is, what is going to happen to taxes in the future? Currently, our top federal marginal tax rate is the lowest we've seen in history at just 37%. But it was as high as 94% back in 1944 and 1945 as we ended World War II. And they hung in the 90s, really for 2 decades until the 1970s. We didn't start to see taxes come down below 50% until 1987, and that was due to the Tax Reform Act of 1986. And even still to this day, we see taxes hanging somewhere between mid to upper 30s. And as of today, we are in November of 2025. The US just crossed over $38 trillion in debt and counting. And with people living longer due to modern medicine, programs like Social Security, Medicare, and Medicaid are getting drastically underfunded and are actually scheduled to be insolvent within the next decade. Now, with all of that being said, unfortunately, no one has a crystal ball that can actually predict what will happen to taxes in the future. But if you are young and you are saving for retirement today, and maybe you have 20, 30, maybe 40 years to go until you retire, there's a high chance that taxes have a chance of going up in the future just to cover all of the expenses that we're incurring today. So what can you do to protect yourself? You can start to transition your money into accounts that grow it accessible in the future, all tax-free. Now, one I'm sure you've probably heard of is a Roth IRA, which are decent. There's just a lot of rules, restrictions, and regulations, and if you break them, you will pay big taxes and penalties. And if you make too much money to qualify to own one, that's your next problem. If you make over $150,000 a year and you're filing single, or over $236,000 a year and you're filing married, you are going to be essentially too wealthy to own a Roth IRA. You would have to contribute into a traditional IRA and then backdoor those contributions into a Roth IRA at a later date. The downside to that is we don't know for how many more years the government will allow backdoored Roth IRAs. They have been threatening getting rid of them for quite some time, so this strategy might not be an option. And even if you do this, there are such low contribution limits allowed into IRAs in general. $7,000 a year if you are under the age of 50, $8,000 a year if you are over the age of 50. And with the rate that inflation is compounding at today, you're going to have to save way more than that to retire comfortably 20 to 30 years from now. This is why I educate my clients on the value of using tax mitigation strategies that leverage high cash value insurance contracts to grow and build wealth accessible, all tax-free. How it works is a sliver of your dollar goes to cover the cost of the insurance contract, and the rest spills over into the cash value account that is growing and compounding at high rates of anywhere on average of 8 to 10% interest over the last 20 years. This cash value account is accessible 100% tax-free through the secret sauce, which is called a policy loan. Policy loans allow you to use your money that's inside the cash value account as collateral. You actually borrow from the insurance company, which allows you to access your money 100% tax-free, and you can use it for anything, at any time, at any age, without any penalty. This essentially allows you to put your dollar for use in 2 places at one time because you're not actually withdrawing it from the account, you're borrowing against it, so you're not interrupting the compound interest that's happening inside the insurance contract, and you can leverage that dollar to go and purchase anything else that you'd like. This is an area that a Roth IRA cannot compete in. And when it comes to these insurance contracts, there are no restrictions for opening them up based on your income. You control your annual contribution limits. They are not set in advance for you. And you can access your money at any time, at any age, without any penalty. The downside to these contracts is you have to get approved. And it's not necessarily based on your income, although that is considered, but it's based on your age, your health history, and your criminal background. The insurance company is placing a bet that you are going to live for a very long time. So therefore, they don't want to take anybody on board that might be deemed risky in terms of insurability, that they might pass away too soon. Now, because of the fact that there is an approval process to these accounts, typically the younger you are and the healthier you are when you get these set up, the better this account is going to look for building wealth for you, accessible, all tax-free. A lot of times I sit down with people in their 40s and their 50s and they look at these strategies and they wish they would have started this 10, 20, 30 years prior. So if you are young, if you're in your 20s or your 30s or even your 40s, I would highly recommend you take a look at these strategies and sit down with a licensed financial professional to analyze your portfolio and see if these are things that can help you shift money into accounts that will grow accessible tax-free. If you'd like to work with me or my team on it, you can click the link in my bio or in the description below to get access to our calendar and schedule a complimentary consultation with us. And if you like this idea and you want to explore how these accounts work, I've linked 2 videos here that will dive deeper into how these cash value contracts work. Make sure you subscribe so you don't miss another video teaching you some of the best ways to grow and build wealth accessible tax-free. And I'll see you back here next week on YouTube.